Hi guys. Today we will analyze Bank of New York Mellon Corporation, commonly known as BNY Mellon, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also, recent evolutions are not positive. The short-term trend is negative, while the long-term trend is still neutral. Strong support levels are around $41.40 and $35. Next support level is around $33. Strong resistance levels are around $44 and $46.50. Next strong resistance levels are around $50 and $59. In the last month the stock has been trading between $41.20 and $47 range. It is currently trading near the lows of this range. The stock has an average volume of 4.6 million. This is a good sign, as it is always nice to have a liquid stock. The stock has been in a downward trend since February 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Valuing financial institutions. Understanding why financial institutions are different from traditional real sector companies is key. Banks function differently than traditional cash flow-driven companies. Traditional companies create products to make money. The products of banks are money. Banks are highly levered and they do not reinvest debt in the business and instead use it to create more money. They make money via interest. So, they view debt and interest differently. That's why, our favorite discounted cash flow valuation method doesn't work for banks and insurance companies. Intrinsic values calculations. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. The excess return model. This approach is used for financial institutions where free cash flow is difficult to estimate. Then, we will use valuation based on earnings per share, EPS, 5-year average PE ratio and expected growth rate. First model. Excess return model valuation. This spreadsheet contains some financial data that we will use for the stock valuation. In this valuation I will use margin of safety. 30%. Once we actually figure out what we think this stock is worth, we are only going to buy the stock if it gets 30% of what we think it's worth. It gives us a big margin of safety if our predictions are wrong. In other words, when something is worth $1, I want to pay only 70 cents for it. I want to be conservative with financial institutions. So, my margin of safety is 30%. According to our formula, the fair value of the stock is $73.19. When we apply the margin of safety to that value, the fair value of the stock would be $51.23. That's the price that I may want to pay for this stock. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for BNY Mellon is 4.04. Minimum rate of return. I will use 10%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For BNY Mellon forecast growth rate around 4% per year in next 5 years, and future PE around 9. I will use 3 different scenarios for BNY Mellon Company: bad, average, and good. First scenario. BNY Mellon will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future PE would be low, 9. In this case, the fair value of the stock today would be $18. Second scenario. BNY Mellon will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future PE would be average, 11. In this case, the fair value of the stock today would be $25. Third scenario. BNY Mellon will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 13. In this case, The fair value of the stock today would be $32. As you can see, today the stock is a bit overvalued, $41, even if we expect the company's high performance in future. The company's profitability is below average. Also, the stock is expected to show a very small growth in the next 5 years, 4 to 6% yearly. Based on that, the stock looks overvalued at the moment. Also, the stock has been in a downward trend since February 2022, and it can go lower before it recovers. I may consider buying the stock for the dividend, 3.28% yearly, when the stock drops below $32. Company's strengths. The Bank of New York Mellon Corporation, commonly known as BNY Mellon, the world's largest custody bank, is a global investment company that helps clients manage and service their financial assets throughout the investment life cycle. Through its Bank of New York predecessor, it is among the oldest banks in the world, having been established in 1784 by a group that included American founding fathers Alexander Hamilton and Aaron Burr. The company delivers investment management and investment services in 35 countries and more than 100 markets. The company's large operational deposit base translates into a robust funding and liquidity profile, complemented by the strong balance sheet with limited credit risk. BNY Mellon is a diversified custody bank that should benefit from rising rates. In addition to custody, it has a strong market position in a variety of businesses, such as ADR servicing and mutual fund subaccounting, and it is the only clearer of tri-party repos. Compared with peers State Street and Northern Trust, BNY Mellon is the most diversified with its 7 lines of business. It is also less exposed to movements in equity markets. The company has a profit margin of 22.6%. This is comparable to the industry average of 22.8%. Risks. The business model for securities processors carries several major risks. First, the processing businesses involve significant fixed costs for systems and technology, and require ongoing investment to improve processing speeds and efficiency. In addition, margins are thin. As a result, the ability to add volume, preferably from new clients and stronger activity levels, is critical to earnings growth. Revenues are dependent on market trading volume, new security issuance, market volatility, and the price performance of the markets themselves. The company has a return on assets of 0.8%. This is below the industry average of 4.7%. The company has a return on equity of 8.8%. This is below the industry average of 15.6%. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 2 to 4% on average per year. The earnings per share will grow by 10% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.